I do not think the AI bubble is over yet. I agree with many great investors that this market looks very unreal and gamble market, but I also think we may be entering the late stage of the bubble market. After the June FOMC meeting, I believe the stock prices could start rising even faster. When we look at past bubbles, there are some common signs that usually appears first. The first one is new technology. It can be anything that makes people feel very hopeful. But in stock market history, new technology has usually played that role. For example, we can think of three major bubbles period about 100 years ago. Before the Great Depression, there was the 1920s boom. At that time, electricity and communication technology were the big stories. Thomas Edison's General Electric and AT&T came out at that time. Then came the spread of personal computers and the internet age. During the pandemic, we had the platform boom and the work from home trend. And now we have AI. So the question is simple. Are investors and real companies both excited about AI and also scared of failing behind because of AI? I think the answer is yes. So this first condition is very clear. I think many people watching this video would agree with that. But new technology alone is not enough to move the whole market is a huge way. I think the second condition is much more important. For the stock market to move this strongly, we need a K-shaped economy. That means some sectors are doing very well, while other parts of the economy are not doing well. If the strong sector is technology and the weak sectors are things like a normal consumer spending and jobs, then policymakers care more about people working and earning wages than about new technology. So even if company earnings feel strong to us, there can still be pressure to cut interest rate. Past bubbles often work this way. The strong sectors were very strong, but the weak sectors were still weak. So rates were cut to help the weak side of the economy. During the dot-com bubble, for example, TMT companies, telecom, media, and tech had very strong numbers. But the broader US economy surprises data was not that strong. So rates were cut. But when rates go down, does the money really flow into normal spending and jobs? Or does it go to the place that is already working? The answer is, we know the answer. Money goes where it can make money. That is why this kind of setup is very good for the stock market. Right now, the split in the economy may be one of the biggest we have seen in the last 100 years in US. And in a strange way, that can be good for stocks. The market can start thinking, my earnings are strong. The companies I own are still doing well. I did not even expect rate cuts, but now there may be a chance of rate cuts too. That kind of thinking can make the market very powerful, and that was happened last year. Of course, many people are worried about this part. Recently, hopes for rate cuts have come down a lot, and some people are even talking about rate hikes, even though the chance is still low. But I think we need to look at this in a different way. Since last year, we had the tariff fight. People said that if the US cut rate while other countries raised rate, the dollar would become weaker. Earlier this year, we also had the US-Iran war issue. Every time a big macro issue came out and shook the market, but when we look back, most of those issues were forgotten. Why were they forgotten? The key point is this. If oil prices go up, will companies suddenly stop moving toward AI? If tariffs goes up, do you think companies suddenly change their AI plans? I don't think so. So let's say interest rates become the new issue. If rates go up, can that stop big tech from investing in AI? Recently, AI-related sectors and big cloud companies in the US have been growing revenue by around 25% a year. But these companies can borrow money at around 5 to 6% through corporate bonds. So if they can borrow at 5 to 6% and still grow more than 20%, there is not much reason for them to stop investing. There is another reason I feel more sure about this. If we look at Google's earnings, Gemini-related revenue showed good growth from the previous quarter. Anthropic, which got a lot of attention earlier this year, also grew revenue more than 3 times from a year ago. That makes this market still look early. Big tech companies also have a lot of future orders and demand waiting. At first, many people thought, can this really make money? But now the people start to think, wait, this is actually make money. Then people start to believe that this could be an industry growing 30 to 40% or more. If that is the case, 5 to 6% borrowing cost may not be a big problem. Let's say rates go up next FOMC. Some sectors will clearly get hurt. Normal consumer spending, real estate, and housing can feel the pressure. But if the housing market slows down, will AI investment stop? I don't think so. That is why these macro issues can work as excuses for pullbacks when the market gets too hot. If we look back to before last year's tariff fight, stocks like Palantir had already gone up a lot. The market was technically stretched, so when a good excuse for a pullback appeared, the stock fell. But in the end, it did not hurt the company's earnings. I think the US-Iran war issue was similar. Rates can be seen in the same way. Of course, there are many past numbers showing that stocks can fall when rates rise. But in the past, stocks broke down after rates hiked because tight policy hurt the real economy and damaged earnings. I think today is different. If rates rise a little now, the key drivers of this market, AI investment, may not break right away. Just think about Alphabet. It has been issuing a lot of bonds recently, even in Canadian dollars and euros and even Japanese yen. Would that suddenly stop just because rates are a little higher? I think that is unlikely. A simple example is this. Imagine you run in a business. Everyone around you is struggling, but your store is doing very well. If sales are strong, even if materials cost go up a little, you can say it is okay, we can raise prices a bit. People are still buying from us. AI related companies are in a similar spot right now. Another example is a street with 10 stores. Most of the stores are empty, but one store is packed with customers. People walking by may not think the whole economy is booming. They may think only that store is doing well. Something feels strange. That is close to how today's market feels. This is why news articles often say this market feels strange. People say the market is too narrow and only a small number of stocks are leading. Now let's go back to rates. Do we really need more rate cuts for this to become a bubble? I think the rate cuts we already had last year were enough to light the fire. The important point is that policy already turned toward easier money once. Last year, people were still not sure, but now the mood has changed too. No matter what happens, this AI story works. I think rates played an important role in that change. Right now, rate cuts do look difficult. There is also a lot of short-term market noise. But the key is that rate cuts already happened last year. Starting in last August, rates were cut about 3 times. Some people say rates should go up, while others say they should come down. But overall, I think it will be hard to policy to move quickly. And today's rate level is still too low to stop AI activity. That is why I think the 3 rate cuts from last year were very important. Many conditions are already in place. There is also an interesting pattern from history. During the dot-com bubble, rate cuts happened around September 1998. But the interesting part is that the market really started rising after the rate cut stopped. The same thing happened during the pandemic in 2020. Once the rate cuts stopped, stocks began moving higher. That is worth thinking about. Before that point, people were not fully sure about the strong story, so they wanted lower rates. But once rates calmed down and people started to think our sector is very strong, this market is very strong, 2 things can happen. First, hedge funds and other investors in the US can start borrowing money to buy more stocks. Second, companies can use the good funding market to issue bonds or do more IPOs. Before rates were holding stocks back. But after a certain point, the situation can turn around. The bond market may want to lower rates because jobs and spending do not look that strong, but then the money goes somewhere else. It does not go into normal spending or jobs. It goes into stock market leverage or into companies raising money for investment. The inflation or a bubble can appear in the wrong place, and the Fed cannot cut rates anymore. That is why it is interesting that stocks can become very strong after rate cuts stop. Right now, rate cuts have stopped. Maybe policymakers wanted to cut more. They may want to use the job market as a reason to lower the government's debt burden, but they cannot do it. Why? Because stock prices and company earnings are too strong. So from now on, the situation is the opposite. Before rate cuts helped create higher stock prices, now stock prices and earnings may be too strong that rates cannot come down. That is why I do not think this is the time to worry about peak yet. I think this may be the time to think about the last stage of the bubble market. Of course, when people hear the word bubble, they feel uncomfortable. Most bubbles end badly. So it is normal to feel worried. It is also natural to think, what if this is the top? That is why I think we need to look at the signs that appeared near the top of past bubbles. In many past bubbles peaked, four conditions were usually there. The first one is people buying stocks with borrowed money. In a normal cycle, smart money comes in first. Then big institutions come in during the middle, and at the end, the general public comes in. There is a famous story about the shoeshine boy. A famous investor was getting his shoe shined, and the shoeshine boy started giving him stock tips. When taxi drivers or shoeshine boys start recommending stocks, it feels like almost everyone who can buy has already bought. One good way to see that is a margin debt, or money borrowed to buy stocks. In history, around the major tops in September 1929, March 2000, and December 2021, margin debt had roughly doubled from the bottom. If it doubled from the bottom, that means people bought a lot. At that point, you have to wonder, did everyone who wanted to buy already buy? This condition does look somewhat hot right now. As of last November, margin debt was up about 80% from the bottom. Now it has come down a bit around 65%. So yes, this part does smell like overheating, but the next signs are not here yet. The second sign is a big increase in a stock supply. This means companies use expensive stock prices to raise money from the market, and then many companies start making the same kind of investment. IPOs and stock offerings in the US have been rising recently. If we include the SpaceX listing in June and possible OpenAI and Anthropic listing near year-end, this could move above the pandemic peak. That part may already be coming, but the real issue is not just those famous companies. We need to see companies that nobody has heard of going public at crazy prices. For example, a company with almost no revenue trying to list at a huge value. During the pandemic, we saw many of those. Newly listed companies would explode higher even when people did not really know what they did. For that to happen again, people need to believe that IPOs are free money. They need to rush into every new listing. But right now, IPO stocks are not really beating the market in a huge way. We remember names like Circle, and recently there was Cerebras, Firefly, Figma, and Bullish. Their stock prices are not terrible. Some are trying to rebound, but compared with the market leaders, the performance is not that amazing. If IPO stocks were doing insanely well, many more companies would rush in, but we are not there yet. So I don't think this second condition is fully here. The third sign is when small and mid-sized growth stocks start to doing extremely well. In 1999, Russell 2000 stocks were very strong. During the pandemic, many people remember the Cathie Wood's ARK investment. It owned companies that were losing money but were seen as major innovation names. Those kinds of stocks need to become very strong, but we do not really see that yet. For the market to truly smell like bubble, even people who do not know much about stocks need to come in and feel like money is being printed for them. Today's market is different. Only some stocks are going up, and the ones that are going up have strong earnings. At past bubble tops, many unknown companies, like never heard the names, went up and went public. We're not seeing that yet. Stocks like SanDisk and Micron have very strong numbers. So there are two sides to this market. One side says this is bubble, the other side says no, these companies are actually making great numbers. I think the market has to become completely one-sided before we can say the top is very close. If both sides are still arguing, I don't think the market has fully lost reason yet. The fact that there are still critics is actually healthy. When even those critics disappear, that is when the market becomes truly irrational and the top may be near. So from here, we need to watch whether those things actually happen. Since they have not fully started yet, I think we should judge the market by watching those signs. So overall, I think many conditions for a bubble are already forming. I know it may sound strange to say this in this kind of market, but I still do not see the real signs of the final peak. The four conditions I talked about need to be in place before we can really call in the peaks, and we are not there yet. If we look at the past market history, the final stage often has a much faster rise and much volatile. So this may not be a market where investors can sit comfortably and make easy money. It may be a tiring market that gives people a lot of stress, makes them buy and sell in the middle, but still keeps moving higher overall. If the final stage of bubble start to appear, I will share the information right away. Thank you for watching and see you in the next video.